Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. My name is Michael Hewson and joining me again is Pepperstone's Senior Market Strategist, Michael Brown. Good morning, Michael.
Very good morning to you, mate. It's been another choppy and eventful week in the financial markets.
It has indeed. Actually, I mean, we've seen, I think, a lot of choppiness. And we've seen a lot of headlines, obviously, which have been dominated, I think, largely by the Moody's downgrade of the United States AAA rating. For me, they've been the last man standing for about the last 2 years. S&P downgraded the US in 2011. I think he was still at school then.
Yes, I would have been, yeah.
Fitch in 2023. And they did put the US on notice at the end of last year. So this isn't really a surprise. And I think an awful lot more of it is perhaps being made of it than perhaps really is the case. So.
Well, no, I completely agree with you, to be honest. I mean, as we were just speaking about before we press record, essentially Moody's are just catching up 14 years later to what's already been done. To be completely honest, even if you read through the report, there's not really anything in there that's new information. We know that the US is on an unsustainable fiscal path. Even Jay Powell, the Fed chair, has said that. So, yeah, I'm surprised that people are surprised that this has happened, if I'm being completely honest.
Well, before we crack on, I'll obviously give you a little bit of a summary of what we're going to be discussing, and we'll probably go into wider detail about some of the bond market shenanigans that we've seen this week. We'll also be looking back at this week's economic numbers out of the UK, as well as the latest results from JD Sports, Marks and Spencers, and obviously the effects of the cyber attack, Vodafone, BT Group, EasyJet, as well as looking ahead to the latest numbers from B&Q owner Kingfisher next week, and the big one, Nvidia. But before we get started, it's risk warning time because we almost forgot that. So here we go with the risk warning. The information provided here, whether from a third party or not, is to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. As I say, a lot's been made of the downgrade. Yes, obviously it's headline news, but it's not really a surprise. The AAA rating was, as I say, the last one from the big ratings agencies. And I think this is the perspective that's needed in this week where we've seen bond yields, particularly in the US. They haven't really moved that much. Obviously, the headline number is obviously the 30-year, it's above 5%. But I think there's also been talk about moves in Japanese bond markets, Michael. I'd like your perspective on that, because obviously there's been talk about that could be the canary in the coal mine for the bond markets in terms of increased volatility going forward.
Yeah, absolutely. I mean, I think there's a few different issues going on. Obviously, as you say, we have seen a sell-off across what is a significantly steeper treasury curve. And, you know, the fact that the 30-year has burst through 5% has attracted a lot of headlines. But, you know, the actual, well, where we sit at the moment, the change on the week is only about 10 basis points or so. It's not actually huge. I agree with you. I think the moves that we're seeing elsewhere are probably of more interest and perhaps more importance. There are idiosyncratic issues in Japan with the BOJ trying to pull back on their bond buying and slow the pace of their bond purchases, which is having an impact. But really, I think this speaks to the fact that we're talking about the deficit in the United States. We're talking about the fiscal fragility of the United States. This isn't just a US issue. Yes, the US has probably its biggest budget deficit outside of a recession that we've ever seen. But you also have significant budget deficits on this side of the Atlantic. Look at the borrowing data we had out of the UK earlier in the week. The outside of COVID, the second highest April borrowing figure we've ever seen. You've got a similar situation in France. You've got a similar situation in Japan. So I think this is really just perhaps the start of the market starting to wake up to the fact that not only is the fiscal trajectory unsustainable across developed markets, but also there doesn't seem to be any effort to get a grip of the situation either.
So essentially the downgrade doesn't mean that the US is a riskier bet now than it was a week ago.
No.
You know, the US isn't alone when it comes to concern about its debt profile.
Yeah. And also I would argue that actually Treasuries don't need a credit rating. They are by far and away the safest thing out there, and they will probably always be the safest thing out there. It doesn't really matter what combination of three letters and numbers a ratings agency wants to give them. You are always going to want treasuries over anything else, I would argue.
I think this also speaks to a change of perception when it comes to ratings agencies than was the case, say, for example, 20 years ago. In 2005, a ratings agency downgrade was seen as a big thing. But in the wake of the financial crisis and the fact that they assigned AAA rating to an awful lot of what I would call CDO rubbish, I was going to say the S word there, their credibility took a massive knock.
Yeah.
And ultimately, I think credit rating downgrades now, they certainly don't mean as much as they used to. And I think there's a perception that some people in the mainstream media are basically trying to make it a bigger deal than it actually is.
Yeah, I mean,
it's a big deal. Sorry, it's a big deal to say, for example, for you and me and our credit rating in terms of our ability to borrow money from lenders and what have you. People will demand a higher interest rate. But when you're talking about sovereign nations, it really doesn't make that much difference.
Especially not sovereign nations in developed markets as well. I think emerging markets is a different kettle of fish. But absolutely agree with you in terms of DM, and also the other thing is, as you alluded to right at the start, this is not the first downgrade that the US has seen. In fact, it's the third. So it shouldn't be coming as a surprise. It just feels, to be a bit blunt, it feels lazy to just say markets this week have traded on the back of the downgrade, because there are other things going on. And frankly, if anyone woke up on Monday morning and came to their desk and went, right, Moody's have downgraded the US, I'm going to reassess my entire approach, probably doing things wrong, I would say.
I get diversify your risk away from the US, and I think that's potentially what is happening. People are sort of lightening the load on their dollar-denominated assets. It certainly doesn't mean the US is less investable now than it was a week ago or even 5 years ago. Ultimately, it's still the biggest market out there, and ultimately, I think if the US is uninvestable, then we're all in big trouble.
Yeah, I would fully agree, and I think we're a hell of a long way from that point. There is a difference in reducing allocation, which was massively overweight anyway, and the market becoming uninvestable. I think what we're seeing is a move to a sort of more normal level of asset allocation towards the US, as opposed to any sort of fleeing of the states or in terms of capital.
So essentially, what we're looking at is an essential readjustment in risk profiles.
Yeah, and whether that be in bonds or in the equity complex, I think that's literally all we're seeing at the moment.
Yeah, well, that certainly makes sense. Talking of yields, we've seen a big jump in the UK yield profile, and we think of England's cut rates at the start of the month, and the 5-year yield is now at 4.2%, and it was at 3.95%. So much for that rate cut. It's certainly not been reflected in the bond market, even though it has been reflected in my savings rates, which have been cut.
Yeah, and mine. That isn't just a UK phenomenon, though, to be completely honest. Again, this was something I was talking about earlier in the week with a few clients. Even if you look at the United States, I mean, the Fed have delivered 100 basis points of cuts over the last 9 months, and yields across the curve are probably 100 basis points higher over that time period.
Yeah, but they didn't cut rates this month. The Bank of England did, and the move in the yield in the UK has been bigger than the move in the yield in the US.
It has, but it's also understandable when, yes, the BOE delivered a 25 basis point cut, but they delivered a much more hawkish than expected statement and vote split to accompany that cut. So you've got a big repricing of policy expectations on the back of that. And of course, you then had, which I'm sure we'll get onto in a second, the hotter than expected April CPI data to just help that move along a little bit more.
Let's talk about that.
Go for it.
Well, no, I mean, what's your thoughts? I mean, 3.5%. I mean, that's a big jump from 2.6. I mean, we spoke last week that anything under 3 would be a good number.
You're absolutely right, and we're clearly not under 3, and we're not only above market expectations, we're also above the Bank of England's forecast, which was for 3.4. Yes, the services number, that's attracted a hell of a lot of attention, going up to 5.4 from 4.7. That's its highest level since last summer.
RPI.
We're not going down that route, are we?
No, but RPI went from 3.2 to 4.5. I mean, that's just bonkers.
I just struggle to be worried about it. To be completely honest, we can reel off the list of one-off factors that push the number higher if we need to. But I think fundamentally that there were two issues. One is all of the annual index-linked price rises. The second is some bright spark at the ONS deciding that the survey period should be just before Easter. So, of course, you're going to see services inflation higher because hotel prices, travel prices, food prices are higher around the sort of festive period. But I think you're looking at a situation where, yes, fine, inflation's moved higher, but look at the other side of the economy. The labour market is weakening at a rate of knots at this point. I struggle to see the UK economy at a stage at the moment where businesses will actually be able to increase costs at this clip on a sort of sustained basis. I think this is very much the start of what we knew would be a hump in prices over the summer. And then by July, August, September, we're talking about being well on the way back towards more reasonable levels, should we say?
Okay, so explain this. Decline in energy prices, that was the silver lining in the inflation numbers. This morning's retail sales numbers, explain that. We've seen big price rises in April, and yet retail sales go up 1.2%, and they've been up 4 months in a row. So despite the cost of living crisis that people have been banging on about, including ourselves, for some time, the UK consumer continues to put its hand in its pocket.
No, you're absolutely right. I think the easiest explanation for the retail sales number is the always explanation that we reach for, which is that the sun was out last month. Because basically that's what it was. You know, you look at the components that were pushing it higher, it was people going and doing home improvements, work in their garden, or food, effectively, to go and put on a barbecue. But I am surprised by how resilient the consumer has been. It's a bit of a head scratcher because you sort of look at the landscape and you go, well, the consumer shouldn't be this resilient. As we said, unemployment's ticking higher, wage growth is coming lower, payroll employment has fallen 30,000 in 5 of the last 6 months, and sentiment has fallen quite significantly as well. Yet everyone is still reaching into their back pocket and spending away. Again, I don't want to appear too pessimistic, but is this a case of, okay, we've had 4 good months and a very good April in terms of retail sales. Are we just going to end up giving it all back at some point?
Yeah, I mean, I'm looking at the sector volumes number on the ONS website right now. Food stores was the biggest component of gains within the retail sales numbers. It was followed by department stores. Textile, clothing and footwear stores saw an in excess of 3% decline, which is surprising actually when you consider that Next came out and said that they'd seen an awful lot of brought forward spend from Q2 into Q1 in its Q1 numbers, unless everyone's just shopping at Next and no one else.
Which is a little bit hard to believe, I'm not going to lie.
I really don't understand that dynamic. You know, the ONS is telling us one thing and the retailers are telling us something different.
Yeah, it is a very odd dynamic, to be completely honest with you. And I'm in the same boat. I also don't understand. But it's not just retail sales where we have this issue with UK data at the moment. I mean, you know, the labour market data is a classic example, you know, and even GDP growth. This is why the Bank of England and trade and PPI and God knows whatever else. And this is why the
PPI
BOE
come into it.
Did you? Oh, no, did you?
No.
Oh, no, PPI is out as well. Last couple of months. They've realised recently that PPI has been wrong since November of 2020. They managed to go through a whole economic cycle without accurate factory gate price info, which is...
Is that both input and output prices?
Yeah, the whole thing.
So that tends to be a leading indicator for CPI and RPI.
Well, if it's right.
What's the next shoe to drop then? If input prices and output prices for PPI are wrong, then you can conceivably argue that the calculations around CPI and RPI could be suspect as well.
Yeah. And I think we have made that argument around GDP. If you can't get trade data right, how can you produce an accurate GDP estimate? Yeah, and I know we sort of laugh about it, but it is a scandal, I think, and I don't say that lightly because, you know, we've had fiscal and monetary policy and market participants trading on the back of numbers and an economy which could look completely and utterly different to what the ONS are telling us it's meant to look like.
Well, there's another aspect to look at in this regard. How can the Bank of England make sensible decisions on monetary policy if they're not getting accurate data from the Office of National Statistics?
Well, this is why they've ended up, and again, because I'm boring enough to do this and read all of the monetary policy report that they issued a couple of weeks ago, they've actually started to create their own series of economic indicators in terms of economic growth, underlying economic growth, and the state of the labour market, basically because that's the only way they will have a clear idea of how things are developing. It's shambolic.
Yeah, I mean, Germany came out and revised up its Q1 numbers this week as well to 0.4%, which I struggle with when I look at the PMI numbers that have been coming out of that country for the last 2 to 3 years. I mean, because manufacturing is a much larger component of their economy than is the case here in the UK, and yet their economy expanded by 0.4%. So I don't think it's a problem that's unique to the UK. I think there needs to be questions asked about the whole topic.
Yeah. And it's been an issue for a while, and I think the ONS, it's probably impacted them more than anyone else for whatever reason. But even in the United States, there have been issues with response rates to the surveys that go out for things like the labour market report. Those survey response rates have been falling quite considerably for a prolonged period of time now, and it does sound like quite a geeky topic to discuss, but it's an important one because these data are what, as you rightly say, interest rates are being set off. It's what tax and spend policy is being set off. It's how investors are making investment and asset allocation decisions. And we don't actually know whether it's accurate and whether we can rely on it or not. It's ridiculous.
Well, I think we've probably done that topic to death. I mean, obviously, we talked about public sector borrowing as well. I'm hoping that's not ONS. It's not, is it, or is it?
Well, sadly, it is, and we benchmark that against the forecast set by the OBR. So that's akin to the blind leading the blind, that one.
Okay. But I mean, it was pretty ugly, wasn't it?
Incredibly.
20 billion.
Just over 20 billion. Yeah, the as I said earlier, the second highest April borrowing ever outside of the pandemic. And again, it just kind of, well, I think we probably said it after the spring statement that it's inevitable we're going to end up with more spending cuts or more tax hikes in the autumn. And when you're starting the year with that grim of a borrowing figure in a month where your revenue went up 6 billion compared to last year because of higher national insurance contributions, more fiscal tightening in the autumn seems inevitable.
Yeah, I mean, 20 billion more borrowing, even though national insurance contributions have gone up. I mean, that's a worry.
It's a huge worry. And I think what's more worrying is that the Treasury will probably turn around and say, okay, well, more of the same. How do we balance the books compared to the OBR's fiscal rules? Well, we're going to raise taxes again. Well, clearly that doesn't work because we see now that it's not working. We see already the detrimental impact that's having on the labour market, but we just seem to be heading down that track once again.
Yeah, I mean, it comes back to the point, raising taxes doesn't generally generate more tax income.
Yeah.
And yet we have bond markets apparently freaking out because Donald Trump's managed to pass the first stage of his big, beautiful tax bill, which is implementing tax cuts. And, essentially bond markets are worried about that. But generally, I would make the case, and it's just about the Laffer curve, isn't it? At what point do tax cuts or tax hikes become counterproductive? Well, we're already at that level here in the UK.
I mean, we've got the highest tax burden in, God knows how many decades.
So, I mean, Donald Trump is adopting the opposite tack and cutting taxes in the hope that will generate more economic activity, which will then increase tax revenue that way.
Yeah, I do think, I must admit, this one big beautiful bill, I mean, that's sort of the most Trumpian name for a bit of legislation ever, isn't it? But I do think it's important to recognise that the bulk of the tax cuts that are coming in that are making permanent the measures that he brought into place in his first term.
2017.
So I guess, yeah, exactly. So one of the sort of ways to frame it is preventing tax increases as opposed to delivering tax cuts. The sort of actual tax cuts that are being put in place, there's no tax on tips and all the rest of it.
I think that's right. I think that's totally right.
I think it's right, but I'm just waiting for JP Morgan to deliver their bonuses in the form of a tip so that people can get out of it or something. I mean, it just seems very open to exploitation.
I think that's a harder case to make. I mean, if you're like if you're like my niece who works in the hospitality industry in the US, she gets taxed on her tips, and ultimately she works very, very hard
Hmm.
for those tips. Why should she be taxed on them?
Well, I mean, you could extend that argument to salary, to be completely honest, but
Well, no, I mean because salary you get come what may.
hmm. Yeah,
Tips are discretionary.
no, I agree, but I think the concern over the tax bill is again probably a little bit overblown. I think
Mm,
yes, it will clearly have an impact on the economy, but is it?
mm,
It's not exactly as if the sky is falling in as a result of this going through the House and passing by one vote. We've got months of work in the Senate ahead of us before this even gets near Trump's
yeah.
desk.
So, I mean, we don't know whether it will be positive or negative
Hmm.
for the economy. It may well be negative, but, given the alternative, and you're right, it's the framing of it. I mean,
Yeah,
essentially what it's doing is it's actually raising tax. It's preventing a raising of income tax.
yeah, exactly that. And you would imagine in the very short term, at least, there would be some sort of a sugar rush that boosts growth as a result of
Yeah.
it passing. Whether it has a prolonged long term upside economic impact on economic growth, time will tell. I think ultimately.
I think that's the way to frame it. If this bill doesn't go through, US taxes will rise and the
Hmm.
US economy will slow
Yeah,
because people will have less disposable income.
exactly
If it
that.
is passed, the status quo will be maintained.
Yeah,
And I think that's the
absolutely.
way to frame it.
Yeah, and that's a
Unfortunately,
much
that's not
better
the way it's
framing.
being framed.
No, of course not. The framing is, huge tax cuts, huge increase in borrowing, etc., etc.,
Yeah.
etc. As you say, that's absolutely not the right way to be looking at things.
All right, well, let's look back at this week's company numbers because by and large, I think actually companies are doing reasonably well. Certainly stock markets this week, particularly here in Europe, are still nudging towards their recent peaks.
Hmm.
The DAX, I think, made another record high this week. US markets slightly more constrained, shall we say. I know you put out a piece earlier this week saying that about the S&P.
I wondered whether you would bring this
Yeah.
up.
Yeah, the S&P and the Nasdaq have moved back above their 200-day moving averages, and which you see as a positive sign. And
Indeed.
I wouldn't disagree with that. What I would do is caveat that slightly by saying the Russell 2000 are not back above the 200-day moving average, nor is the Dow. So it's not as cut and dried as perhaps you think it might be. There's something called Dow theory in
God.
technical analysis, which suggests that you need confirmation of a move above a 200-day moving average from another area. And certainly we are seeing that, I think, in European markets as well. But the fact that two US markets are below the 200 and two are above isn't of itself conclusive
Well,
yet.
let's sack off the Dow because it's completely and utterly pointless.
I know you
I'll
love the
take
Dow.
I'll take your point on the Russell. I'm not going to take anything on the Dow when it's just being skewed by United Health, who are having an absolutely torrid time of things at the
Mm.
moment, and they're the third biggest stock in the index. I think you're right, and what I would say is, on a sort of broader point, I think the market has been suffering from a bit of exhaustion this week. The news flow and the data flow have both been relatively light. I'm talking specifically in terms of Wall Street. The only notable development has been that tax bill passing through the
Mm.
House, which, as I slightly tongue in cheek said yesterday, the market reacts to something that we all knew was going to happen anyway. So you would imagine that was priced in some time ago. And also, of course, and we'll discuss this in a short while, you've got this huge risk around Nvidia earnings next week. So
Mm.
why would, you're kind of sat there going, is now the time to be adding fresh longs? Market participants saying probably not at the moment. Let's wait and see what Nvidia say, and then we can reassess.
And we're coming towards the end of the month. We're a week away from the end of the month.
Of
So
course.
there is an element of that as well. Okay, so let's look at the numbers this week. JD Sports, I'll start with JD Sports. Full year results saw the shares slip back slightly, up 10.2% to just shy of £11.5 billion. Profits before tax slid 11.8%, but they're still pretty decent, 715 million. But I think it was the guidance that I think spooked an awful lot of people. I was looking at the sales growth for last year, which was 5.8, but trading this year has got off to a slow start. And I
Yeah.
think that's what people are concerned about, particularly in the US, which is now a much greater proportion of their sales profile,
Yes.
and obviously tariffs.
Well, I was going to say that is, of course, the big elephant in the room there. How are tariffs going to impact the firm? I think with the vast majority of retailers at the moment, we have a lot of uncertainty around tariffs and the impact they're going to have. One thing it is going to do, certainly with Trump running around saying people like Walmart should be eating the tariffs, I thought it was interesting that we heard from Target this week saying that they are going to largely eat the tariffs. Well, all that's going to do is really compress margins quite considerably, and as an extension of that, limit the ability for any sort of discounting to take place. So that is potentially another headwind to growth. And as you say, that's a much more important geographical region to their organization now than it has been in years gone by.
Yeah, I mean, JD Sports gets most of its goods from China and Vietnam, so obviously they're mostly so in terms of reallocating their supply chain or readjusting their supply chain, they're obviously got bigger concerns.
Yeah.
Particularly since the US operation is now much bigger, given the fact that not only do they have foot asylum, they've now acquired a company called Hibbett, which increases their sales profile in the US. So having said that, though, I mean, profits expectations for the new year are around about £890 million. So that's not too shabby for a clothes retailer.
No, it could be a lot worse, couldn't it? But I guess the market's mood is a question of, are they going to be able to meet those expectations given the potential headwinds that could crop up and are already cropping up?
Whereas you mentioned Target, so I'm going to skip over to that because we were going to talk about that. Their problems have continued. They missed on Q1 revenues, they missed on profits, and they cut their outlook for the year. So, they're obviously not doing what Walmart are doing, and they are continuing to struggle. And on guidance, they expect a low single-digit decline in sales for 2026, blaming declines in consumer sentiment, uncertainty over tariffs, yada, yada, yada. I mean, this comes across as excuses, I think, given that in March there was a big surge in consumer spending in the US, and yet they've seen no benefit from that.
Well, that's exactly the point I was going to make, and we've got some more consumer sentiment data out of the States next week. There has been this big disconnect between, sentiment has fallen off a cliff, and we've seen sentiment fall off a cliff here in the UK as well, but people are still spending, and as you rightly said, we did have a decent retail sales report for March. We had an okay-ish US retail sales number for April as well. If you are a retailer and you're coming out going, well, we're not experiencing any of this, alarm bells are going to start ringing pretty damn quickly at that point.
I mean, there hasn't been much of a share price reaction simply on the basis of the fact that Target shares are pretty low anyway. So I think an awful lot of it is already...
Can they get beaten up anymore?
Yeah, exactly that. Home Depot, which is obviously the US equivalent of B&Q, and they posted a fairly decent quarter, and they said they don't feel the need to look at increasing pricing at this point, despite the risk of tariffs. And they've also diversified their supply chain away from China.
Yeah.
So they look pretty much set fair. They still expect total sales to go up for 2026 by 2.8%. So there's a compare and contrast going on there. Yeah, they're different types of retailer and what have you. But Home Depot, the B&Q equivalent, they didn't have a particularly bad quarter, even though most of the US was covered by snow and ice in January, February, which they did point to.
Yeah, and I thought that was actually quite interesting that they had a decent quarter despite that. But yeah, it is interesting how fortunes are sort of varying across the retail sector in terms of discretionary and staples, but also within those subsectors as well, as we spoke about last week with the different performances of Walmart and Target. But yeah, I do find it interesting that Home Depot are another one who've come out and said we don't think we're going to need to increase prices, because from a macroeconomic point of view, we're all sat here going, well, inflation's going to head higher as a result of tariffs. Well, actually, a lot of the big retailers aren't going to be passing on price increases. Maybe inflation won't be heading higher, and where we're actually going to see the impact show up is in a slower pace of earnings growth.
Yeah, I mean, but the thing is, with US retailers, they do have to worry about tariffs. Here in the UK, we don't, because we didn't retaliate.
Yeah, of course.
I think that needs to be taken into account.
No, okay, and that's probably one of the few good moves that the government have actually made, is to not retaliate against the tariffs, because you'd just have been shooting yourself in the foot if you did.
Yeah, well, I mean, my view on that is a stop clock is always right twice a day. Anyway,
we wait with bated breath for the second time that they'll be right.
Yeah, exactly. Let's move on to Marks and Spencer. Not much to dislike, really. Fairly decent numbers, but obviously no one wants to talk about them. It's about the cyber attack, and they think it's going to cost them £300 million in lost profits. So 2026 is more or less of a write-off, and they're not likely to be back to normal by the middle of the summer.
Yeah, and I think that was probably, it's always very difficult to gauge where expectations are in terms of this sort of thing, but I think that was clearly towards the much more pessimistic end of where people were expecting, both in terms of the cost and in terms of the timescale. And something we obviously discussed last week is the impact that it will have in terms of the brand value and the brand image. And the longer that we go with things not being fully back to normal, not being able to order online and signs of empty shelves and all that sort of thing, the more and more detrimental impact it will have on the brand, and ultimately the longer it will take for them to rebound from it. So I think that was rather a disappointing update, to say the least.
Yeah, I think there's a wider issue question here, because obviously M&S isn't alone in falling victim to these. I mean, we've heard about the Co-op, we've heard about Harrods as well. But I think the wider question is what this means for retailers in general when it comes to cyber attacks. Because if this can fall victim to this, then what other retailers might fall victim to it as well? Because these types of fraud are becoming more sophisticated. Apparently, the fraud is something called SIM swapping. I did a little bit of digging into it, and this can circumvent two-factor authentication, because what it means is the hackers can gain control of your phone and make the retailer think that they are actually talking to the original owner of that phone. And that's how they got into M&S systems by a third party. Well, M&S can't control third party attacks because they don't have control of the technology. They only have control of their own technology. So essentially what SIM swapping is that someone sends the phone user a phishing email, making them think that they're actually talking to the retailer. They click on that link and they somehow steal the SIM information and then trick the phone provider into changing your SIM because you say you've lost your SIM.
Yeah, and you'd imagine that it's not only retail that could be exposed to this sort of thing.
No.
It could be any sector, anywhere, literally any business, whether they be public or private, because I think pretty much everyone is using two-factor authentication because you're much more clued up on IT than I am, but I remember years ago being told this is the way to make everything nice and secure, and actually now that seems vulnerable to exploitation.
The weakest link in the chain is always this human being at the end of the phone clicking on a phishing email.
Yeah.
So ultimately, for me, I think, and this is something that I always do, if I get an email purporting to be from a retailer or, a company with which I do business, and they ask me to click on a link to take them to their website, I never click on that link.
No, just go and Google the website.
I basically go to my browser and then type in the address for that retailer. I do never, ever, even if I'm 100% certain that this email that I've got is from the retailer in question, I'm so ultra cautious. I think, right, okay, I'm going to open Chrome, Firefox, Edge, whatever, and I'm going to type in the web address myself. Manually.
And I think this speaks back to the whole point with this sort of thing, where the people who are doing the attack need to be lucky once out of 100,000 times. Yeah. The people defending against the attack need to be switched on and lucky all the time to stop it from happening. And as you rightly say, one weak link and they're in, as we've seen with NES.
Yeah. So, I mean, that for me, I think is the biggest concern. It's really about these sorts of cyber attacks are becoming much more sophisticated. And ultimately, the weakest link in the chain is always the person who essentially has this in their hand.
Yeah, exactly.
So any phishing email, I mean, free advice here, never click on a link in an email that you receive. Always go to your browser and do that and basically type in the address there.
There you go. Come for the analysis, stay for the security tips.
Anyway, moving on. Vodafone, I'm sorry, but the share price reaction to these Vodafone results has
anyone managed to get to the bottom of this yet?
No, I don't think they have. So let's talk about the numbers. I mean, do you want to do the numbers or shall I?
Well, you can do the numbers while I'll do a little bit of digging while we speak.
Okay, so full year revenue saw an increase of 2%, 34.7 billion euros, helped by a 2% increase in organic service revenue of 5.1%. The debt position has improved. It's fallen by 10.8 billion euros, but that's because of the sale of the Italian and the Spanish businesses. So you would expect that. The company also announced a 2 billion euro share buyback. The elephant in the room is the business in Germany, which continues to act like a ball and chain around the wider business. Having already thrown 20 billion euros into it already, the company posted an annual loss of 3.7 billion euros due to having to book a 4.4 billion euro impairment on its German business there. So I think the key takeaway for me was that how much worse can it get, and things can only get better. There's a song there, I think.
Please don't sing.
I'm not going to. So, what I'd like to believe the CEO, Margarita Della Valle, that message is becoming a little bit old when it comes to Germany, because the German business has been struggling for years, and it's always jam tomorrow. But the market seemed to like what they had to hear, and we saw a big jump in the share price. But it only happened after midday, not immediately after the results.
Yeah, which in itself was very odd. While you were talking, I was just digging around to see if there was any sell side commentary. And I think everyone's as much of a loss as we are. You look through the results, and as you say, I mean, I do feel like I'm clutching at straws here, but if you want to pick out some positives, yeah, fine. They're talking about how things in Germany are going to get better, but as you say, they always talk about how things in Germany are going to get better, and they never seem to. Service revenues were a little bit better than expected, but again, is that going to drive such significant upside? Probably not. They did launch a new share buyback program, but again, it would be strange to see the stock vault higher 6 hours after that news comes out. All very, very weird, unless it is, as you sort of slightly nodded towards there, a case of the market kind of having gone, well, things can't get any worse for them, so it's only going one way. But that doesn't seem a particularly convincing investment case in my mind.
No, I mean, there is more optimism over the UK business. Obviously, the merger with Free set to complete in the next few weeks, and the UK is its strongest business. Germany accounts for 33% of its revenue. There's been a drag for some time, so hopefully things can get better there. But I think for me, we're still within that range that we've been in pretty much since the end of 2023. 78, 79p on the upside, and sort of around about 65p on the downside. I think if we are to see the shares move into a new range, then we need to move above 80p. So at the moment, we're still within that wider range that we've been in since the end of 2023.
I was going to say, I've just pulled up a chart, and we've been in that range for a hell of a long time now, actually.
Yeah,
getting on for 2.5 years.
Yeah. So contrast that with BT Group, and we're talking chalk and cheese, because BT Group, no one appears to be hanging up on them quite yet.
Oh, for God's sake. We've managed to get to, where's my clock? We've managed to get to 41 minutes without a pun. I thought I was being quite well behaved today, and there we go. It's all descended now, hasn't it?
I was just waiting for you there. You're a bit slow there. I think you were just
I was trying to get a chart, and then I was shocked. I was like, no, he didn't actually just say that.
Anyway, so the shares are now back at levels that we saw in July 2022. So certainly Alison Kirby seems to be singing the right song when it comes to generating confidence in the brand. And certainly I think this is despite lower revenues, but profits are up.
Yeah, but again, the market seems to have confidence in the plan. The market seems to have confidence in the brand once more, and the share price reflects that. I guess the one sort of area that is perhaps a little bit concerning is the whole broadband side of things, which is clearly a very, very competitive market, and BT expect that losses there are going to continue, but the reaction doesn't speak to much by way of concern over that.
Yeah, I mean, their guidance, they say they're on target to deliver £3 billion of normalised cash flow by the end of the decade. Full-year adjusted group revenue of circa 20 billion, which is more or less the same as it is the last year. And UK service revenue, again, slightly lower than was the case for this year. So certainly in terms of revenue, we're not expecting to see much growth there.
No.
But in terms of cash flow and profits,
yeah, I think it's a bit sort of drive to make the business more efficient as opposed to a drive for revenue growth seems to be the idea there.
The biggest decline in revenue came in its business division, which was down 4%. Openreach saw an increase, however, to 6.15 billion consumer was down, but full fibre rollout continuing apace, and company was raising its build target by 20% to up to 5 million UK premises in full year 2026, on top of the 18 million already delivered and 6.5 million connected. So obviously the full fibre broadband rollout does appear to be paying dividends on that front. So
Indeed.
share price is the highest level since July 2022. Can we get back to £2? We're at 175p at the moment. £2 is the 2021 highs, I think. Yeah, 2022 highs actually. So certainly the momentum appears to be in its favour.
Absolutely.
Okay, so I'm going to move on, and I'm going to open myself up to punnery here. EasyJet.
Hit a bit of turbulence, haven't they?
Well, actually, they haven't. They're just sort of taking off and gaining altitude. Moving back towards the December 2024 peaks after their numbers. But they did slip back initially, but now they're up above 570p.
I just want to hear your management speak that I know is coming here.
What management speak?
Well, what
No,
did EasyJet describe? Oh, you're not doing it?
I'm not doing it. You can do it if you want. I'm not going to get the grief for it.
What, the price stimulation, which is what everyone else knows as discounting, but they decided to call it something fancy. Clearly they had some consultants in.
Yeah, I know, that's nonsense, isn't it? An 8% increase in first half revenues, decent numbers on the revenue count, but the losses, £394 million, which was higher than last year's £350 million. Now, you may recall last week, their Q1 losses were £65 million better than Q1 the previous year. So their Q2 losses must have been humongous.
Yeah, I'm not entirely sure what's happened there, because as you say, at first glance you kind of go, well, what on earth happened in the second quarter to suddenly see this huge loss mount up?
Well, I'm guessing it was what they call price stimulation. They cut prices to basically get their load factor up, because the load factor was 87.5%.
Yeah.
Now, when you look at Ryanair have a load factor of around about 93%. So certainly, I think there's scope for them to be able to put more bums on seats. Ancillary revenue was up 7%. Ancillary revenue to you and me is basically the purchase of goods and services on the aircraft. So teas, coffees, snacks, that sort of thing, because you have to pay extra for that. Passenger revenue up 5%, and holidays revenue up 29% to £400 million. You know, holidays is a very small component of that £3.5 billion. You know, £400 million or £3.5 billion is still a very small amount.
It's not really worth worrying about, is it?
No. But they still reckon that profit for this year is going to come in at £703 million. So certainly they're expecting to make over £1 billion in the second half of the year.
Yeah, and as we said last week, EasyJet do tend to enjoy a much, much better second half of the year. But again, it's a question of, are they going to repeat that trick once again in 2025? And they clearly seem confident that they're going to. Well, certainly, I think if we can get back through the peaks that we saw in December last year, which was around about 590p, we're just shy of that now, 570 odd p, and move through 600p. There's certainly no reason to suppose that we can't do that. When you consider that back in 2021, post-COVID, the share price was at 900p. So you'd say there's no reason why we can't get back to that sort of level. So you could argue that EasyJet is actually undervalued, and certainly has potential to gain an awful lot more altitude when it comes to the share price. Can we move on? Anyway, let's move on to next week. Next week's a bit light, shall we say? Which is basically why we've gone on for so long with respect to what we got. First quarter GDP out of the US. Again, no surprises there. This is going to be the final number. There was a contraction because of a big surge in imports. That's not likely to change. It could well reverse in Q2. In the same way that UK GDP was so good, well, you saw a big surge in exports to beat the Trump tariffs. So there's a Trump tariff bulge or contraction there on both sides. The only thing I would say in terms of GDP, and again, it's a second estimate, so it's not going to matter too much, but I think globally there is the potential for these figures to be revised to a much more significant degree than we would tend to see. Usually we'd go, sort of 0.1% at most would be the revision. Given how uncertain the economy has been, and given how uncertain the outlook has been, and given how much has been changing, particularly in terms of trade flows, I think there is the potential for these revisions to end up being pretty chunky. But again, is it going to matter too much in the grand scheme of things? I struggle with that one.
We got Fed minutes, so are we going to be having any surprises from the Fed? Obviously Trump's
No.
banging on about Powell not cutting rates, and I've said this once and I'm going to say it again. It's not after Powell. He needs to convince every other member of the FOMC. Powell can't cut rates on his own.
No, you're absolutely right. And I think let's just ignore what the orange bloke is saying, because the Fed are going to ignore him, and rightly so. There's nothing that the Fed can do at the moment other than say policy's in a good place. We will act if we need to act. And unless and until we need to act, we're going to stay firmly in a wait and see mode on the sidelines. That's exactly what the Fed are doing, and I think that's exactly what the Fed are going to do for quite some time to come, to be completely honest with you. And certainly this week's minutes, I think, will be a very, very dull read, because there's nothing they really can say at this moment in time.
Most recent payrolls report, decent, 177. Unemployment, 4.2%. Inflation numbers showing little signs of moving the dial one way or the other.
Yeah.
Consumer confidence, yes, that is weak, and we can talk about that a little bit. Now, this consumer confidence number, I'm assuming that you have slightly more confidence in this one than you do in the Michigan consumer confidence numbers. Can you explain to our listeners the difference between the confidence surveys, please?
Yes, I can. I will do it in short. I think the biggest difference is in the sample size that is used. Correct me if I'm wrong, the University of Michigan surveys about 600 or 700 people. The Conference Board, which is the data that we get next week, surveys somewhere near 5,000 people. So it is a much, much more representative gauge of overall consumer optimism or pessimism. Although what I would say is it is still going to suffer, albeit probably not to quite the same degree, from the issues that the Michigan survey has, which is a massive skew depending on your political allegiance. It seems to be a case in the United States at the moment, if you ask a Democrat-leaning voter, how do you think the economy's going? Well, they think it's a complete dumpster fire. If you ask a GOP-leaning voter how they think the economy's going, they think things have never been better. And I think this is why overall, no matter where the survey data is coming from, it's very difficult to distill any signal from the noise in this data. And I think that may also be one of the reasons why we haven't yet seen the weakness there feed into the hard data in terms of consumer spending and business investment and all that kind of thing.
Yeah, because we did see a sharp slowdown in April to 86 down from 93.9, but that's not surprising given the noise around tariffs, and obviously Liberation Day. Yet at the same time, the slowdown that we saw because we were above 100 at the end of last year on consumer confidence, we're now at 86. Retail sales in March jumped by 1.7%, I think.
Yeah, exactly.
So, there's a complete disconnect there. So,
yeah, and actually the other thing that I would say, and I haven't got a chart on this in front of me, is, but just anecdotally speaking, there is actually a relatively close correlation between consumer confidence in the United States and the performance of equities on Wall Street. So because the market has picked up 15, 16, 17% or so since the last consumer confidence print was out, you would expect that to also help make people a little bit more optimistic about the situation.
You would think so. So, basically we've got Fed minutes and US core PCE and Q1 GDP next week. So there's really not that much, I think, that could move the dial. We'll talk about Nvidia in a minute. Let's talk about Kingfisher, B&Q's owner. Since we last spoke about them, the share price has actually gone up. We've seen some fairly decent gains, got up to around just below 320p in the middle of this month. We've come back to around about 300, just below 300p now. Yeah, I think given the retail sales numbers that we saw today and have seen over the course of the past 3 months, you would think that Kingfisher's B&Q, given what we were talking about barbecue and gardening equipment and everything else, you'd see a fairly decent set of numbers when these numbers get released on the 28th of May. French operation continues to be the basket case in this operation, but certainly I think I'll be looking for any adjustment to their pre-tax profits estimates for this year and whether or not we'll see a fairly decent performance in their Q1 numbers, which could be reflected in the numbers that we've seen out of the ONS. be an interesting dynamic, that one, I think.
Yeah, it certainly will be, and I think you're absolutely right. Given the makeup and the composition of that retail sales data earlier, it does lay the groundwork to what you would expect would be a relatively decent quarter for the likes of Kingfisher. But the question now is, can they live up to those expectations? Because the bar has probably been notched a little bit higher on the back of those figures.
Certainly, the technicals are looking fairly positive for Kingfisher in terms of the share price, and I know how you feel about technicals, but for me, they're the one.
Can you not say that when I'm having a drink? Try not to kill me off.
Well, okay. Well, we'll move on for that. But I mean, for me, they're the one guiding light in terms of how I look at timing entry into investments and trades, because it's about momentum.
No, in terms of momentum, the big one, Nvidia.
Yeah, well, let's talk about that. What are you expecting for next week, Michael?
Well, do you know what? I think the issue for Nvidia, and we'll run through the precise numbers in a second. I think the issue for Nvidia is the same as the issue has been for a number of quarters now, where they've set the bar so high that it's almost impossible for them to live up to market expectations, not only in terms of margins and performance over the last few years or so, but the reports that they've delivered have just constantly been very, very solid. And when we're sort of sat here complaining about, margins went from 71% to 70%, I think that tells you everything you need to know. It's sort of that classic case of they're reporting at a time when they're effectively priced to perfection. It's kind of difficult to deliver a set of results that would impress the market against that backdrop.
Yeah, we've rallied from $87 lows in April, and at the start of April, just post Liberation Day. We're now at $133, give or take the odd dollar.
Flat on the year.
Flat on the year, so not too shabby. Let me remind you, I think, of what we're expecting. I think in terms of this is the guidance that Nvidia issued when they basically published their gang-busting Q4 numbers, and they were gangbusting. The guidance for Q1 of 26 is for revenues of $43 billion plus or minus 2%, with operating margins set to slip to between 70.6 to 71% from the 73% that they were at the end of Q4. Will tariffs impact that number? Will uncertainty? Will you get actually what we might see here? This has just occurred to me. To beat the tariffs, you actually might see
a bit of a surge.
A bit of a surge in revenues, and those $43 billion in revenues could actually be higher.
Yeah, no, there's definitely a case for that, and I think you're right. It's a case of we've seen front running everywhere else. Why would we not see it here? Yeah. The other thing that will be interesting to hear Nvidia's comment on, and I think this will come on the call as opposed to in the earnings themselves, is obviously this big relaxation in the chip rules that the Trump administration announced recently, and how they think that's going to impact things from Q2 onwards. I think that's going to be another thing that's worth watching closely. But that's a very good point on front running. I think there's definitely a strong case to be made for that.
Okay, well, certainly that's something to keep an eye out for, and obviously the guidance for Q2.
Yes, of course.
Okay, so that's it pretty much for this week. So to summarize, stock markets continue to hold up reasonably well. US markets slightly weaker, yields slightly higher. Cables at 135. I booked my trip to the US in August, September. So happy days. May it continue going up. And the dollar's not really done that much, aside from weakening a little bit further.
But it's been a controlled move. It hasn't been it has. Given that we're recording this at midday on a Friday, I hope I'm not going to put the kibosh on things now, but it has been a relatively calm week, at least compared relative to where we've been over the last 6 weeks or so.
Indeed, and obviously we've got a long weekend here in the UK, I believe.
And in the United States, it's Memorial Day on Monday.
Right. So basically it'll be there'll be a bit of position squaring ahead of the long weekend.
Yes.
In the later hours of today.
Absolutely.
Okay, so that's it for this week. We'll be back again next week to talk about the Fed minutes, Q1 GDP, and more importantly, Nvidia. So tune in then, where we'll basically chew through the numbers and find out whether they are disappointed or whether those chips short-circuited.
Goodbye.
Goodbye. Have a great weekend, everybody.